Welcome back. Wall Street's wild ride. Futures pointing to a pretty good rally at the start of trading. Yeah, pretty good. 867 points until you compare it to what happened yesterday. The Dow on track to claw back almost half of yesterday's sharp decline, which was better than 2,000 points lower on the Dow. Joining us right now is CFRA Research Chief Investment Strategist Sam Stovall. And Sam, it's always great to see you.
Happy to be here.
And what we want to talk about is the reaction to what's going on is a reaction to the economic story. So the impact of coronavirus on the economy is supposed to be severe, expected to see a sharp slowdown in growth. You are great with the fundamental backdrop in terms of the economy. Tell us where we are.
Well, I agree with you that basically, first off, I think that consumers are reacting the way new parents are to their first child getting a cold. You know, they're just freaking out about it.
We're overreacting, you're saying.
Overreacting. But the thought is that that's not something that you can really control. So concerns right now are how weak do earnings get? Right now, expectations are for a 4.8% gain in 2020, and questions are maybe we get no growth whatsoever. At the same time, that would probably bring down investor confidence and therefore the PE multiple that goes along with those earnings. So, you know, as a result, I would tend to say that we probably in some ways have to go back and retest the lows from 2018.
But, you know, it's all about expectations, right? I mean, you know, you say we have to adjust. We're acting like parents, you know, with their kids' first cold. Once the market has a clear expectation of what this might mean, we'll just change our behaviors and we'll just get through it. I mean, I've been saying on the air a number of times, we're going to see tens of thousands of cases leading to hundreds of thousands of cases of coronavirus in America. It's not a death sentence. Some people will die. Other people will just, it will flow through you. But you'll get used to it and you'll adapt your life to it. We haven't seen that yet.
Right. Well, personal hygiene is not a bad thing.
Yeah.
So increasing that, I think, certainly would be very good. But you're right. I think investors, consumers need to figure out where is the bottom, where can things start to advance, that they can feel less worried and actually be willing to go out once again.
With that said, Sam, do you think there's a significant change in supply chain management now going forward after we get through this, given that we relied so much on China to be a good actor, to produce, to buy from us, and now we've seen the big interruption that they've created?
Absolutely. That it's diversification in terms of countries, but it's also making things a lot more local so that you don't have to worry about borders being shut down, that actually you can get your supplies that much more quickly from a local
But we
supplier.
saw yesterday, this is a credit issue where you have had Scott Minerd from Guggenheim Partners writes the financial contagion is spreading rapidly into credit markets where not only energy bonds are plunging, but other sectors like airlines, lodging, and retail. And because of Stephanie Pomboy, who on this program literally years ago pointed out corporate debt has exploded post-crisis. It is now at a record 9.9, nearly $10 trillion, a record both in absolute terms and relative to GDP. And Minerd writes, the prospect of a crisis at maturity, that a borrower with maturing debt finds it impossible to roll the debt over to pay it off, is a very real prospect for companies even that are solvent. That's why the market basically came unglued yesterday.
Well, that's a good point, because when you first look at lower oil prices, you say to yourself, well, the rule of thumb is that every $10 decrease in the price of oil increases GDP by 25 basis points. But when you then look underneath the covers and you say, well, wait a minute, where's most of this global debt being found? It's basically in energy-related companies, energy-related bonds, etc. Irving Fisher, the great economist who in 1929 said we have permanent plateau of prices just before the market crashed, actually said in the mid-30s, the reason we had so many companies go under is because of the amount of debt that they had to service.
Yeah.
They couldn't cut prices quickly enough in order to increase the volume to service that debt.
And now we see how important that is. And Diggins right, Stephanie Pomboy has been so adamant about this one issue, that corporate America is so leveraged and it's going to be a problem. And that is what we're seeing now. And Robert Kaplan, Dallas Federal Reserve, said the same thing. In fact, Stephanie emailed me and said, bingo. And I said, yeah, you've been saying this now for a couple of years. Sam, it's good to see you.
Happy to be here.
Thank you so much. Sam Stovall joining us there. Coming up, the Trump